everyone, welcome to our last video here in ACCAFE Express. In this video, we will be discussing the master budget of ACCAFE Express, particularly the sales budget, the production budget, the expected cash collections, expected cash disbursements. We also have the direct materials budget, the direct labor budget, the manufacturing overhead budget, the selling and administrative budget, and for our highlight, we have the budgeted income statement of the ACCAFE Express. Along with me in this video is Noriel Alisoso, Lionel Caballes, Christine Cahinta, and Jamie Cambing, and yours truly, Andrea Bernardino, who will be discussing the master budget of ACCAFE Express. We hope that we'll be able to discuss it clearly and you'll be able to learn more about ACCAFE Express through our master budget. To start, we have provided the budgeted sales for ACCAFE Signature Coffee, particularly for the next 12 months in year 2022. So our assumption here is that each month, our unit sales will increase by 10 units. So for January, we have 3,600 units. It will increase by 10, which is on February 3,610, March 3,620, and so on and so forth. We have also provided a number of unit sales for the year 2023, which is January 3,720 units, February 3,730 units, and March 3,740 units. We have also summarized it by quarter for easy reference at the right side of the PowerPoint. So we have here the first quarter, 10,830 units, second quarter, 10,920 units, third quarter, a total of 11,010, and fourth quarter, a total of 11,100, with a total budgeted sales for the year of 43,860 units. So for our sales budget, we just simply multiply the number of unit sales per quarter by our selling price, which is 150 pesos for the ACCAFE Signature Coffee. So we have here units for January to March, or the first quarter, 10,830 multiplied by the selling price 150, which is total 1,624,500. So for the second quarter, April to June, we have units of 10,920 multiplied by the selling price of 150, a total of 1,638,000. And August to October, or the third quarter, we have 11,010 multiplied by the selling price 150 equals 1,651,500. And November to December, for the fourth quarter, we have 11,100 multiplied by 150, the selling price. We get a total of 1,665,000. So the total number of units to be sold is 43,860 multiplied by the selling price, with a total sales budget of 6,579,000. So for our expected cash collections, our assumption here is that 100% sales are on cash. It means that there are no sales on account. So shown below is the total cash collections per quarter. We have collections for the first quarter, 1,624,500. Second quarter, 1,638,000. Third quarter, 1,651,500. Fourth quarter, 1,665,000, with a total expected cash collections of 6,579,000. That will be all for my part. Thank you for listening.
Hello viewers of ACCAFE Express, I am Christine Cahinta and I will discuss ACCAFE Express production budget. So the production budget must be enough to cover the budgeted sales and to provide for the desired ending inventory. So the assumption here is that the management of ACCAFE Express wants the ending inventory to be equal to 20% of the following month's budgeted sales in units. So since this was the first year of operations, thus there will be no beginning inventory for the first quarter of January 1, 2022. So next. So here you can see in our screen is the production budget. So how do we get the required production? So this is by adding the budgeted sales by the desired ending inventory. That is what we get the total needs na. And then we deduct our beginning inventory, and then here we get our required production. So for the first quarter from January to March, it was discussed earlier by Andrea Bernardino that our budgeted sales for the first quarter is 10,830, and then we add our desired ending inventory of 726. So how did we get this figure of 726? So since it was stated earlier, it was assumed that the ending inventory is equal to 20% of the following month's budgeted sales. So we get 726 by multiplying the budgeted sales of April of 3,630 times 20%. So we get 726. And then we add that to the budgeted sales. So 726 by plus 10,830. So we get a total needs of 11,556. And then we deduct the beginning inventory. So here, since nga it was stated again earlier that the beginning that this was the first year of operation, so there will be no beginning inventory for the first quarter of January 2022. So 0. So 11,556 minus 0, so we get the required production for the first quarter of 11,556. So for the second quarter, so budgeted sales is 10,920, and then we add the desired ending inventory of 732. So how did we get the 732? We multiply 3,660 by 20%. So 3,660 times 20%, we get 732, and then we add that to the budgeted sales. We get 11,652, and then we deduct the beginning inventory. So where did we get the 726? So simply this is the ending inventory of the first quarter. So for the second quarter, our beginning inventory is the ending inventory of the first quarter. So we deduct that 726 to 11,652, we get 10,926. So for the third quarter, for the budgeted sales, 11,010, and then we add the desired ending inventory of 738. How did we get 738? We multiply 3,690 by 20%. So where did we get this 3,690? Again, this is the budgeted sales on the month of October. So that is 738. So we add that, and then we get 11,748, and then we deduct beginning inventory of 732, or the ending inventory in the second quarter. So we deduct that, and we get 11,016 for the third quarter. So for the last quarter, for the fourth quarter, so the budgeted sales is 11,100, and then we add the ending inventory of 744. That is 3,720 times 20%. And then we get 11,844, and then we deduct the beginning inventory. That is the ending inventory in the third quarter. So we get 11,106. So that is it for the production budget. So for the first quarter, yung required production is 11,556. For the second quarter, 10,926. For the third quarter, 11,016. And for the fourth quarter, 11,106. So moving on is the direct materials budget. So the assumption here is that the management wants materials on hand at the end of each month equal to 10% of the following total material needs for production. So here you can see in your screens is the direct materials budget. So how did we get these figures ba? So to get this, we multiply the required production to the materials per unit, and then we add the desired raw materials ending, and then we deduct the beginning raw materials. So we get the total materials purchased. So we have 1, 2, 3, 4, 5, 6, 7 direct materials for this product. So first is the coffee beans. So to get the total materials purchased of the coffee beans, we identify the required production. So how did we get this 27,030? So earlier I discussed the required production. In our production budget, I discussed the monthly required production. So in the second table, we as you can see the monthly required production. So we add that all up, we get an amount of 27,030. So 27,030, we multiply that by the materials per unit. So that is 15. So for the coffee beans, 15 grams. So we multiply that by 15, we get 405,450. And then we add our ending desired raw materials. So that is 3,345. So how did we get this 3,345? Simply we get that in our production budget. So we add that, we get 408,795. And then we deduct our beginning raw materials of 0. So why 0? So since nga, to reiterate, this is the first year of operation. So we have a 0 beginning inventory. So total materials purchased, we have 408,795 for coffee beans. So for the milk, same computation, but yung materials per unit niya lang is for milk is 500 milliliters. So we multiply that to 500. So 27,030 times 500. Same computation, we add our desired raw materials and then we deduct our beginning raw materials. So we get 13,626,500 for the milk. For the flavored syrup, so since yung flavored syrup, yung materials per unit niya is 120 ml. So we multiply 27,030 to 120, and then we add the raw materials and then we deduct our raw materials beginning. So we get 3,720,360. So for the cinnamon, again, the same computation. So our total materials purchased for cinnamon is 136,265. And then for the cup, 27,253. For the straw, same, 27,253. And for the tissue, again, the same, 27,253. So as you can see in the table, after we get our total materials purchased, we have to identify our total disbursements. So how do we get our total disbursements for each of the direct materials, for each of the 7 direct materials? So we just simply multiply that to the cost per unit. So yung cost per unit ng coffee beans is 2 pesos per grams. Yung milk is 0.04 pesos per ml. So for the flavored syrup, 0.125 per ml. For cinnamon is 3 pesos per gram. For the cup is 20 pesos. For the paper straw is 10 pesos. And for the tissue is 5 pesos. So we multiply these figures to the total materials purchased. So for the coffee beans, 408,795 times 2, we get 817,590. For the milk, 30,626,500 times 0.04, we get 545,060. For the flavored syrup, we multiply 3,270,360,000 to 0.125, we get 408,795. For the cinnamon, for the fourth direct material, we multiply 136,265 by 3, so we get 408,795. And for the cup, 27,253 times 20, we get 545,060. And for the straw, we multiply 27,253 again by 10, we get 272,530. And lastly, for the tissue, 27,253 times 5, we get 136,265. And to sum these all disbursement for the direct materials, for the coffee beans, for the milk, for the flavored syrup, cinnamon, cup, straw and tissue, we get a total of 134,095 of total disbursement annually. So that's it for my report. And next will be our expected cash disbursement. So thanks for watching and continue listening. Thank you.
So after determining the sales budget, the expected cash collections, the production budget, the direct materials budget, we now go to determine the expected cash disbursement of the company. So we assume here that the 90% of the month's purchases is paid for in the months and a quarter of the purchase, and the balance is paid in the first month of the following quarter. So for the first quarter, January to March, 90% of the month's purchases, which is 768,964, is being paid, and the remaining balance, which is the 10%, 75,300, it is recorded or paid in the next quarter, which is April to June, and 90% of the month's purchases is equal to 677,697, and the remaining balance will be paid in the next quarter, 75,300. Again, the 90% of the month's purchases, August to October, is 683,286, and for November to December, the remaining balance from the third quarter is 75,921, and 90% of the month's purchases, which is 690,738, is also recorded for the last quarter. So in total, for the first quarter, the company paid 768,964. For the second quarter, 752,997. For the third quarter, 758,586. For the last quarter, 766,659, with a total of 3,047,206. We now proceed to direct labor budget. So we go with the assumption that the management wants materials on hand at the end of each month equal to 10% of the following total material needs for production. So the company has no layoff policy, so all employees will be paid 40 hours per week. Workers are paid at a rate of 50 per hour regardless of work hours. For the next 3 months, the direct labor workforce will be paid for a minimum of 1,000 hours per month. So given here is a direct labor budget, which composed of 4 quarters. So in the first quarter, the unit of production provided is 11,556. For April to June, 10,920. August to October, 11,010. And for the last quarter, 11,106. So it is now multiplied to the required direct labor per unit, so which is 0.1. So the total labor hours required for first quarter is 1,156, second quarter 1,092, third quarter 1,101, and for the last quarter 1,111. Then it is now compared to the guaranteed labor hours, which is 1,000 per quarter. So the budgeted direct labor hours for January to March is 1,156, April to June 1,092, August to October 1,101, November to December 1,111. So it is now multiplied to the hourly wage rate provided by the company, which is 50 pesos per hour. So the direct labor cost for the first quarter is 57,800, April to June 54,600, August to October 55,050, 50. November to December, which is the last quarter, 55,550.
Okay, let's proceed. We have here the manufacturing overhead budget. So when we say manufacturing overhead budget, this budget involves the cost of manufacturing overhead that is directly related to our operations and particularly our product costs. So for assumption, manufacturing overhead is applied to units of product on the basis of direct labor hours. The variable manufacturing overhead rate is 5 pesos per direct labor hours. The fixed manufacturing overhead per month is 50,000, wherein our non-cash cost represents the depreciation of our coffee equipment. Let us proceed to the manufacturing overhead budget. What we have here is the schedule of our MOH budget. So we represent our year's manufacturing budget through each quarter. We have the first quarter, second quarter, third quarter, and the fourth quarter. So next, we use the budgeted labor hours and the variable MOH to compute our variable manufacturing overhead costs. Our budgeted labor hour for the first quarter is 1,156 hours. We multiply it to the assumed variable MOH rate, which is 5 pesos, so that we can get the variable MOH cost, which equals to the 5,780. We add it with the fixed manufacturing overhead cost, which is the 50,000. We get the total MOH cost or the manufacturing cost, which is equals to 55,780. We deduct the non-cash cost that represents our depreciation involving the coffee equipment, which is equals to 1,875, so that we can get the cash disbursement for manufacturing costs in first quarter, which is 53,905. Similar procedure will be used in the following quarters, the second, the third, and the fourth. Following the pattern, we have 53,585 for the cash disbursement for manufacturing costs for the second quarter. Alongside with it is the total MOH cost for the second quarter, which is equals to 55,460. For the third quarter, we have a 53,630 cash disbursements for manufacturing costs. And we have a total manufacturing cost of 55,505. For the last quarter, we have 53,680 as our cash disbursement for manufacturing costs. Also, we have a total manufacturing overhead cost, which is 55,555. After getting these values, what is important here is to determine our total manufacturing overhead cost, because later on, when we use it in the identifying the later on we will use it in identifying our predetermined rate when we compute it by dividing the total manufacturing overhead cost to our total budgeted labor hours. So let's proceed. What we have here is the selling and administrative budget. So here we also represent our selling and administrative budget per quarter. And at the right corner, we have our yearly amount. So for the first quarter, in order to get the variable and selling administrative expense, we only need to multiply the budgeted unit sales computed a while ago times the variable selling and administrative expenses assumed amount, which is equals to 5 pesos. So that we can get our variable and selling administrative expense equals to 54,450. Next is we need to compute the fixed selling and administrative expenses. Here we have the following expenses: salaries expense, advertising expense, insurance expense, license and permits, fuel, repair and maintenance, and depreciation, which is the apparently represent our vehicle depreciation. Adding up all these expenses, we have here the total fixed and selling administrative expenses, which is equals to the 852,840. Since this is our fixed selling and administrative expenses, we can presume that to the following quarters, we have a similar amount, 852,840. So what varies here is the variable and selling administrative expenses. So for the second quarter, we have 11,160 as budgeted unit sales. Therefore, we get the variable and selling administrative expenses, which is equals to 55,800. For the third quarter, we have a 11,430 budgeted unit sales. Then we get the variable and selling administrative expenses equals to 50,150. For the last quarter, we have here the 11,700 as budgeted unit sales, multiplying into the variable selling administrative expenses per unit. We get the variable and selling administrative expenses equals to 58,500. Computing this expenses per quarter, we get our yearly annual variable and selling administrative expenses, which is 225,900. Similarly, computing the fixed and selling administrative expenses per quarter, we get the total fixed and selling administrative expense for the year, which equals to 3,411,360. These are important in finding the values in making our income statement.
As we have already prepared and presented our sales budget up to the selling and administrative expense budget, we will now show you our budgeted income statement for the year ending December 31, 2022. So we have here sales 24,421,320. Presented also below is the breakdown of our sales. So in the table, we show you the list of our products as well as its corresponding selling price, unit sales, and the total. So for the unit sales, we arrive at those quantities by multiplying 1% of the quantities shown in our break-even analysis in the previous video. This is assuming that there is a 1% increase. So, adding all the totals of each product, we arrive at a total sale of 24,421,320. Now, for the cost of goods sold, we have 20,088,708. As for its breakdown, we have listed our products as well as their corresponding unit cost, unit sales, and the total. So for the unit cost, we have already shown you this cost in the previous video, which was in the break-even analysis. However, for the unit cost of ACCAFE Signature Coffee, we have shown you already the computation for this in the previous slides. So the number of unit sales was the same in the computation for the sales as well as for the cost of goods sold. So we have here the totals. Adding up all of this will result to a total cost of goods sold of 20,088,708. So after the computation of our cost of goods sold, we reduced this amount from our sales, which will result to a gross profit of 4,332,612. So we also have here our selling and administrative expense of 3,637,260. So for the breakdown, we add the fixed selling and admin expense for the year of 3,411,360 and the variable selling and administrative expenses for the year of 225,900. So the total selling and administrative expenses for the year is 3,637,260. So reducing also this amount from the gross profit will result to our net operating income of 695,352. This amount shall also be deducted by a 30% income tax. So we have here our income tax expense of 208,606. So finally, our net income would be 486,746. So that would be all for the budgeted income statement of ACCAFE Express.
Once again, we are the ACCAFE Express and thank you for listening and thank you, Ma'am Arib.